I'll now invite Mr. Nilesh Shah to come on the stage and take us through his presentation.
Hi, very good evening to all of you. Before coming to the stage, I just did some calculation which I thought will be interesting and worth sharing with you. Of the total 500 stocks in India, 66 stocks are down more than 30% from their 52-week high. About 123 stocks are down between 20 to 30% from their 52-week high. And 216 stocks are down between 10 to 20% from their 52-week high. So indices haven't moved much, but below the indices, lots of stocks have moved a lot, and actually on the downward side, not on the upward side. This is the carnage which is happening in the equity market right now. And the good part is that budget is not responsible for it. It's happening for a variety of reasons other than budget also. So the topic of my presentation is budget and market, and I have chosen Mahabharata to explain it. Before technology gets ready, and you can imagine if technology takes so much time to get ready, for a country like India to get ready, how much time we should give to Mr. Modi. In Mahabharata, I'm sure you would have heard about Khandavprasth turning into Indraprasth. So when the Pandavas were moved out of Hastinapur to set up their own empire, their own kingdom, they were given a place called Khandavprasth, which was nothing but barren land and a jungle. So they invited an architect called Maidano to build Indraprasth. And apparently Indraprasth was a place where you will see land where there was water, and you will see water where there was land. I don't know, our finance minister's nickname was Maidano, but he indeed presented a budget which was like Indraprastha, where debt markets saw land, equity markets saw water, and where equity markets saw water, debt markets saw land. And just look at the reaction of debt and equity market. This is the debt market. It was stable before the budget. With budget, interest rates went up 15 basis points. And when interest rates go up, it's negative. And after the budget also, it kept on climbing up till such time government came and intervened. So effectively, debt market gave a thumbs down to the budget. And look at the equity market. Before budget, it was falling. Post-budget, despite levy of long-term capital gain, it kind of remained stable, went up and down, but more or less stable. And today, it started giving down. But at least during the budget presentation, equity market gave kind of neutral thumb or thumbs up. But debt market definitely gave thumbs down. So how did finance minister presented the budget differently to the debt market and differently to the equity market? Now one could give benefit of doubt, saying that he was speaking in Hindi, which debt market participants understood, and he was speaking in English, which equity market people understood. But there are few debt people who can also speak in English, which is a person like me. I think the budget gave different impression to both the markets at the same time for a couple of factors. The budget was expected to be populist because BJP is facing election, and especially when Rajasthan result came out, everyone is expecting a huge dose of populism. The debt market thinks that this budget is populist. The revenue projection on taxation is higher side. The fiscal deficit number is unlikely to be achieved. At the same time, equity market believes that no, the numbers are reasonable. The GST collection can increase, especially with the e-way bill introduction, which has been deferred, unfortunately. And the fiscal deficit number of 3.3% is achievable. So one market thought budget is populist, other market thought budget is prudent. The second thing was about restriction versus stretch. We believe finance minister has a lot of flexibility, but that's not true. He cannot change excise duties and other duties because of GST Council. His expenditure is fixed because of salaries, defense, subsidies, government expenditure. Effectively, he operates within so much restriction. And probably equity market thought that, well, within the restriction, what he has delivered is fantastic. On the other hand, debt market thought that maybe finance minister could have been innovative, could have stretched limits, and he could have presented a better budget. The third was lack of innovation versus being creative. Just to give you a small example, the finance minister has kept non-tax revenue at almost similar level, increase of just few thousand crore. The divestment target at 80,000 crore is less than 1 lakh crore last year. Now we are proposing 24 companies for strategic divestment, and you are decreasing your divestment target. You are imposing long-term capital gain of 20,000 with an expectation to earn 20,000 crore, which means we should make 2 lakh crore of profit to pay them 20,000 crore, and yet you don't have ability to increase divestment target beyond 1 lakh crore. In fact, you have reduced it by 20,000 crore. So you are not creative enough. So debt market thought finance minister is not creative enough in raising revenue. Equity market thought that he care 80,000 crore to 80,000 crore, at least it's coming. The representation versus reality. The budget speech was talking about few lakh crores here, few lakh crores there, few lakh crores here, few lakh crores there. But when you add the numbers, it doesn't tally. You are rolling out universal healthcare program with 2,000 crore allocation. How will you fund it? You are rolling out building of toilets, making provision of about 13,000 rupees a toilet. Is it good enough? Not. So somewhere equity market took allocations given by the budget as reasonable, as fair, saying that some money will come from government's pocket, some money will come from outside of budget like National Housing Bank, National Highway Authority of India, and central PSU undertakings borrowing. The debt market took a conservative view that you are trying to spend money which you don't possess, hence you will end up borrowing more, and hence this fiscal deficit target will not be achieved. Finally, everything will boil down to vision versus execution. And at least on vision, I will give 9 out of 10 to this budget. There is vision that farmer income needs to double by 2022. And some of steps which they have taken, if executed well, can actually deliver this. Minimum support price to be increased by 50%. So if farmer's cost of making a product is 100, he should get 150 rupees is reasonable. Operation Green will cover 3 critical commodities, potatoes, onions, and tomatoes. For us, it doesn't matter, but they matter a lot to India's inflation. Probably in Monetary Policy Committee, half the time we'll be going for discussion of potato price, onion price, and tomato price. If we can manage Operation Green, then hopefully these things will be better off. E-Connect, removing the middleman, connecting farmer to the consumer, crop insurance, soil card, agro-processing industry, storage, warehouse receipt, futures and options market in agriculture commodities. If we can execute all these things, then there's no doubt in my mind that crop income will double. The second is infrastructure development. Already all-time high allocations have been given to road and railway. Affordable housing are being constructed. More than 50 lakh houses will be constructed. Government has allocated 1,000 crore additional towards Pradhan Mantri Awas Yojana that can create demand for 11 million tons of additional cement. Urban infrastructure is being developed, smart city, InvIT for government projects. If we can execute this, then certainly India will not become like Singapore, but Mumbai will become far better than what it is today. Third, investor confidence. In our market today, we have about $440 billion of foreign equity investors, about $75 billion of foreign debt investors, and we don't know how much private equity guys have put in. It's important for us to maintain comfort and credibility with foreign institutional investors, because the day they decide to take some money out of 440 billion of equity, 75 billion of debt, and probably equivalent amount of private equity, we won't have reserves to pay them back. So we need to ensure that the foreign investors' confidence on India continues to remain there, and that will come through stability of tax laws and stability of political parties or government. The other thing is capital market development. We all know we have more than $1 trillion in gold. Our total import of gold is more than foreign direct investment or foreign portfolio investment received in the country. We have sent more money abroad than what we have received from foreigners. So if we can monetize this frozen saving, which is lying wasted in gold, then certainly economy can improve. The budget has made one-line statement that there will be a comprehensive policy to manage an asset class called gold. For the last 15, 20 years, we have been hearing this statement, but there's no concrete step taken on ground to manage that. Let's hope and pray that government is able to deliver something over there. Market discipline is very, very important. Today, banks are faced with a lot of NPAs. Banks which were happy to give debt capital to so many companies which became NPA, they didn't get any equity capital from most of the mutual funds. People whom we were afraid of giving equity, banks were more than happy to give the debt. It shows the discipline of capital market versus bank loan. Now, if we can deepen capital market, certainly my feeling is that NPA problems will be far lower. Can we channelize domestic savings for growth, or do we have to depend upon foreigners for creating growth? So there are lots of good visions in this budget, but we need to execute it on ground in order to create sustainable growth. Now, let me come to economy. The budget comes and goes. It doesn't impact economy beyond a point. The economy has its own momentum, which can be disrupted by budget or which can be supported by budget, but it cannot reverse that momentum. So it's extremely important for us to realize how the economy is shaping up. And the best way to describe India is this short story about India, which I carried to Japan. In Japan, the problem is that Japanese don't understand my English, and I can't speak Japanese which they can understand. So I thought it's very easy to carry just 2 slides and explain them India. So I carried this chart, and if you see, there is a white line which is steadily growing up. And if you focus very closely, there is yellow, green, and blue line. Now, this is the price comparison of Maruti Suzuki since its listing, vis-a-vis some Japanese companies like Nissan, Suzuki, Toyota, and Honda. Suzuki owns Maruti. So in some sense, Maruti's performance is reflected in Suzuki. And if you see, since listing, Maruti has delivered better return than Nissan, Suzuki, Toyota, and Honda put together. If there was any other automobile company in Japan, I would have added that also. This is the story of India. Over a longer period of time, you can make far more return than what you are going to make in developed world. Even Maruti kind of company will outperform global leaders like Honda and Toyota by a big, big margin. Now, all fund managers need an exit plan for a day like today. When markets have crashed, you need something to save yourself. So fortunately for me, there was plan B in Japan. In Japanese, there is a proverb which says that if you do not enter the tiger's cave, you will not catch its cub. And I'm sure all of you remember very recently in Maruti's factory, a leopard entered. They stopped making motor cars, tranquilized the leopard, and then went back to making motor cars. Certainly, this kind of adventure is not available in Japan in Toyotas and Hondas. For that, you have to come to India. And if you can manage leopard, it's so easy to make money in India. This is the story of equity market as well. We will deliver better return than Hondas and Toyotas of the world. But once in a while, a leopard will come, which you'll have to capture. And you have to ensure that you don't get eaten by the leopard. Let me give you the long story now. So, in the long story, day before the budget, everyone was asking us, Nilesh bhai, when will market crash so that we can invest into the market? I'm sure Hemang bhai, tamne bhi ouch badha puchta haise. Now, I was asking people, why do you want market to crash? So they said markets have become expensive. So to all those people here who believe markets are expensive, let me ask you this question. What is this? It's a modern art, but Hemang bhai, that's worth $110 million. જો આ કોઈને મોંઘું નથી લાગતું તો આપણી માર્કેટ કેને એક્સપેન્સિવ લાગે છે? So, on a serious note, yes, our market from a valuation point of view is on the same P ratio as it was in 2008 before it corrected. But this is not true across the entire spectrum. And this calculation, we did it on 16th of Jan. And if you notice over here, over 10-year average, on 16th of Jan, what was the premium of mid-cap, small-cap, and large-cap? The large caps were reasonably okay at 10%. Mid-caps were at 25% premium, and small caps were at 33% premium. Now, clearly, this was vulnerable. And that's why you saw how small caps have started correcting. So markets were priced for perfection without budget or with budget. The premium of small and mid cap was excessively high over their historical average. And that's why they needed to come down. And my guess is that there might be some more correction left in the market. But very soon we will be reaching near the historical average. If you look at market cap to GDP ratio, which is a thumb rule used by Warren Buffett, we were trading at 149% of GDP in 2008. Today, we are trading at about 96%. So from a P ratio, we look expensive, but from a market cap to GDP ratio, we look fairly priced. It may be a little bit higher, but it's not that expensive that you should exit of equity market. More importantly, our markets have now changed. There was a time when every day in the morning I used to pray to the God that Bhagwan, aaj FII ko buying karne dena so that prices will go up and my investors and I will make money. Now I pray differently. I tell God कि भगवान आज FII को बेचने को बोलना, because वो लोग बेचेंगे तब जाके मैं माल खरीदूंगा, नहीं तो माल मेरे को कौन देगा? This is the change. Earlier, to sell IPO, you had to go to Tokyo, New York, London, Singapore. Now, to sell IPO, you have to go to Bandra Kurla Complex, Nariman Point, and Lower Parel. Your IPO is sold. So, our markets have become very stable because of you people giving money to people like us, and we are deploying that into the market. Now, let's look at some of the challenges which we face. I mean, most of us know what are the challenges, but let's visualize them. The first big challenge is our diversity. If we see our smallest state, Goa, it is a population of 75 lakh. And if you look at our largest state, UP, it is a population of 23 crore, bigger than Brazil. Now, when you try to run this country, you have to manage from Estonia to Brazil together. It's very difficult. On top of it, if you see our per capita GDP diversity, Our richest state, Delhi, is as rich as Indonesia. And our poorest state, UP, which is unfortunately the largest, is as poorer as Nepal. Normally, when we see a Nepali or a Gorkha, the one word which comes into our mind is Chokidar. Next time when you say Nepali, please remember there are 23 crore Indians who are poorer than Chokidars. So please treat Nepalis with respect. We are not a country, we are a continent. In fact, our favorite tagline with foreigners is that, sir, do you believe in God? Most foreigners are atheists. And they said, no. So we said that, sir, please come and visit India. When you will see us functioning, you'll start believing in God. That's the best way to get foreigner into our country. The second challenge is job creation. In Haryana, Jats want job. In Maharashtra, Marathas want job. And in Gujarat, Patels want job. And very soon in Karnataka, we'll figure out someone needing job reservation. It clearly shows that despite adding so many new jobs, we are falling short of what is required to be added. This is a serious challenge. The third challenge is that today our businessmen are not willing to invest into the businesses. The Tatas, Birlas, Ambanis are happy to buy out assets rather than go and put up new assets. And many other industrial groups who went to set up assets in 2008 to 2013 era are now either completing those projects or trying to manage the debt which was taken to fund that project. So investment has come down from 33% to 27%. So our entire economy is running only on one engine of consumption rather than both the engines of consumption as well as investment. Now there are, apart from economic challenges, market challenges. The first market challenge is that Rajinikanth is going to retire. You associate Rajinikanth with impossible things. In our market, we have Rajinikanth, who is called central banker. In 2008, US was sinking with subprime. Ben Bernanke came, started printing money, took over all the subprime loans of Citibank and Morgan Stanley and JP Morgan and Goldman and so on and so forth, and ensured that the entire banking system survived. Same thing happened in European Central Bank. You would have remembered days of Greece, Spain, Italy, Portugal being called as pigs. They were all sinking down. Then Mario Draghi came, started printing money like Rajinikanth, and took all those countries out. Bank of Japan has been doing this job since 1991. So these people have printed enormous amount of money, $12 trillion, 6 times India's size. Now they are all threatening that we will retire. Now if they retire, we don't know what will happen to equity market, what will happen to debt market. This is our fear. We have survived with central bank support. Will we be able to survive without their support? The second thing is oil is moving up. Between 2013 to 2016, oil was coming down, then it stabilized, but now it has gone up. We can manage $40 to $60 of oil. We can survive $65 of oil. But if oil goes back to $100 a barrel, then certainly our equity markets will have to come down because our economy will not be able to bear that pain. Every $1 increase in oil bill is 1,500 crore rupees increase in subsidy bill. This is despite passing majority burden to the consumer. The third is obviously the election. We have all seen how Gujarat election kind of vitiated or impacted equity market. There are 8 state elections in the next year. And then there is mother election, general election in 2019. There are already rumors that it might be preponed. Now, why do we have to worry about election? Because who knows, 2019 could be like 2004. Then market thought that Atal Bihari Vajpayee government is coming back to power with India Shining campaign. Market kept on going up. Then it got doubt whether Atal Bihari ji is coming back or not. And one day we realized that, sorry, it's the market supported by Sitaram Yechuri and Mr. Karath. The left front supported government resulted into market correcting 20%. even without letting them do the work. Before they could begin, we thought, no, they will be harmful to the market. Market came down 20%. Or will 2019 be like 2009? Market then was going down because there was no clarity on what will be the government. After correcting a lot, it kind of stagnated, trying to wait what will be the result. And when they saw Manmohan Singh government coming back with higher majority, market moved back up. It went up 20% in one single day. Or 2019 will be like 2014, where Sensex kept on riding higher and higher and higher as it started getting confident that Narendra Modi government is coming to power. So 2019 election, whenever it will get discounted into market, could be like 2004, rally first, then correction, or like 2009, correction first and then rally, or could be like 2014, where it can just continue to go up. Someone also said that, Nilesh bhai, every year the thing keeps on changing. So maybe 2019 will be only correction, and after result even more correction. So who knows? Effectively, if we take out election, if we take out budget, if we take out government, then for any market, the only challenge is corporate earnings. And if we see India's corporate earning, it is kabhi khushi, kabhi gum. There are periods where it does well, then it kind of consolidates, then it again does well, then again it consolidates. So we are expecting that now gum period is over and khushi period will start. The markets haven't moved in terms of earnings for last 3 years, so hopefully now things will start moving. The only caveat is that we have been making these statements for last 3 years. Maybe we want to be consistent, so one day we will be correct. No, that's not the case. We genuinely believe earnings will go up. Earnings will go up because of this reason. In 2008, corporate profit as a percentage of GDP was 7.1%. It came down to 3%. Effectively, it has come down by 50%. It has come down by 50% because banks are declaring NPA losses. All telecom companies are racing to make losses. Combination of this, along with drop in profitability for other corporates, has resulted into profitability coming down by 50%. Now, businessmen are not Mother Teresa's. They run business for profit. Hopefully, this 3% will start moving up. Why will this 3% start moving up? One, in last 10 years, capacity utilization of India has declined from 80% to 72%. Demonetization, GST, and variety of other things has resulted into capacity utilization coming for India Inc. by almost 8%. All of you know that if you operate plants at higher utilization, you make one kind of profit. You operate at one kind of lower utilization, you make lesser profit. We believe now, going forward, capacity utilization can inch up. This is the year ahead of election. No government would like to give shock to the business community. The economic momentum has started building up. We have overcome the disruptive reform of GST. We have overcome the disruptive reform of demonetization. Hopefully now there will be no more disruptive reforms, and this will allow capacity utilization to go up. Are there signs of capacity utilization going up? Yes, in automobile sector, auto component sector, cement sector, chemicals and specialty chemical sectors, there is distinct trend of capacity utilization going up. The second thing which is happening is that over last many years, the salaries and wages as a percentage of sales have always hovered between 8 to 9%. But in last 3 years, especially FY14, FY15, FY16, our businessmen have become Mother Teresa. They have started paying more salaries to their employees at the cost of their profitability. Today, salaries and wages as a percentage of sales is 11.5%. Businessmen are making 3% lower profit compared to past in order to pay money to their employees. For 25 years, I have worked in job and I'm yet to find a boss who is that kind. So my guess is that at some point of time, this salaries and wages will get rationalized, most probably by increase in turnover rather than reduction in salaries. Hope my boss is not here. But this cost rationalization should again increase the profitability. Apart from these two factors, there is one more factor which has hurt us. And I want to ask you one question. Intoxication is equal to whiskey plus water, gin plus water, and rum plus water. This is the equation. Anyone has a dispute to this? No. So what is the conclusion? Is the conclusion water is equal to intoxication correct? Why such a deafening silence? Right? This is not correct. Unfortunately, our regulators don't realize this. They believe this is correct equation. So for them, low inflation is low oil price plus high interest rates, tight money plus high interest rates, low growth plus high interest rates. So they believe that if you have high rates, there will be low inflation. You see, in India, and this is as of December 17, not of Feb 18, our government of India pays real interest rates of about 3%. I went to a country called Thailand. You know what is the bank deposits in Thailand? 2%. What's the 10-year yield? 2.4%. Now, if a country like Thailand can survive with 2.4% 10-year yield and 2% bank deposits, how can India continue to pay 3% real interest rates? Our monetary policy hasn't changed with the change in inflationary scenario in India. This has kind of created a speed breaker for Indian economy. It is kind of running your car with handbrake on. The businessmen are pressing accelerator, government is pressing accelerator, but the handbrake of high real interest rate continues to create a drag on economy. If this was not good enough, we also have a fairly overvalued currency. And the best way to explain this is our monthly trade deficit with China. We import $5 billion worth of more goods from China than what we export to them. On a yearly basis, this is $60 billion, about 2.75% of India's GDP. You know, we have a hostile neighbor called Pakistan. Pakistan is pretty close to China for a variety of reasons. But one of the main reasons is that because China is constructing China-Pakistan economic corridor in Pakistan, that huge infrastructure project is making Pakistan go towards China. It has, in fact, become China's subordinate. What's the cost of building entire China-Pakistan economic corridor with which China is able to dominate Pakistan? $60 billion. Who finances that every year? You and me. If we all stop consuming Chinese product in excess of what we export to them just for 1 year, we can buy permanent peace with Pakistan. There's no need for keeping military in Kashmir. That's the kind of trade deficit we are running with China. We need another Gandhiji who has to come and tell us ki bhai Swadeshi ban jao. Apart from earnings, there were signs of exuberance. A lot of that has died down right now, but it is probably there. One, I'm sure you must be receiving 5 SMSs every day requesting you to buy Sai Baba, buy Suntech Reality or Sunstar Reality or Computrade or so on and so forth. Please put all of them on auto delete. You will thank me after some time. IPO valuation and retail response. Not all the IPOs were properly valued. Many of them were getting valued beyond large cap stocks. Many of them had very, very limited floating stock and prices were getting ramped up because of concentrated buying. So in IPO market, it's worth exercising caution. Second and third tier stocks were running up on expectations. Now that correction have started, which is good. And more importantly, other than last few days, there was very limited volatility in equity market. Most people actually thought that debt is risky because of the volatility, and equity is very safe because of the return. Now, welcome to the reality. So there was early sign of exuberance getting built in equity market, which fortunately is correcting, become too much. If you read this as Google, we are in safe zone. If you are still reading this as greedy, then market has some more reasons to go down. Ultimately, it's economy which will build India. It will give wealth to you. It will give return to you. Today, we believe India is at crossroads where we are witnessing low earnings growth, low exports growth, pains of GST and demonetization, and legitimately people can ask, where are Achhe Din? In our opinion, this can be linked to Samudra Manthan. When Dev and Danav were churning Samudra, first poison came out, and then Amrut came out. In those days, there was Mahadev Bhagwan, so he absorbed the poison. In Kali Yuga, there is no Mahadev, so some poison is coming into your pocket, some poison I have to absorb. But if we can churn the Samudra, then eventually nectar will come out. Eventually Amrut will come out. Eventually India will become a developed nation. Why are we so confident? Is it to get your money into my mutual fund? Answer is no. We genuinely believe there are three things which is happening in India: efficiency, formalization, and financialization, which has happened in the past selectively but never together. And if these three things can come through together like it is coming today, we can really change our orbit. Let me talk about efficiency. If you see, most of these lamps here are now LED bulbs. 3 years back in 2014, most of the bulbs were incandescent bulbs. When this government came to power, it created a mission called National Ujala Mission. It requested citizens to replace incandescent bulbs with LED bulbs. We all knew LED bulbs are more energy efficient, but before 2014, not many of us bought LED bulbs because it was costing 500 rupee per bulb. Today, we are all replacing LED bulbs into our houses because it's costing 35 rupees per bulb. The government, by October 2017, had distributed 27 crore LED bulbs, helping save you and me in our power bill 14,000 crore. The country saved 7,000 megawatt of power. The target is to go to 77 crore LED bulbs by 2019. This will help save us about 40,000 crore in power bill or 20,000 megawatt of power. Today, I am paying as much electricity bill in per unit cost as a Japanese citizen. Their per capita GDP is 15 times bigger than me. And yet, I am paying same power bill as they are paying. With this LED kind of thing, hopefully my power cost will come down. I can become competitive in manufacturing with that surplus power. Is this 27 crore LED bulbs true? And that's where we want and get the certificate from Agora, because no one will believe black man certificate. This is National Geographic picture. If you notice carefully, there are certain areas where pink shade is visible and there are certain areas where light blue color shade is visible. The light blue color shade shows that part of the world where night glow is increased between 2012 to 2016. And the pink shaded areas are the areas where night glow is decreased between 2012 to 2016. India is one shining star. And if we zoom in, most parts of India, especially the poorest part in UP, Bihar, West Bengal, they all have seen massive increase in night glow, which means electricity has reached there, which means there are so many villages which are getting electricity for the first time after 70 years of independence. There are so many things which government is doing which is increasing efficiency of India. A best way to summarize is this. We had one government which spent 40,000 crore through Manrega in digging holes and filling holes. We have another government which is trying to save 40,000 crore in your pocket and my pocket by just requesting us to switch from incandescent bulbs to LED bulbs. All of us know which government is good for us. The second thing is formalization of economy. We grow highest cotton in the world. We have the highest spinning capacity in the world. But when it comes to converting that yarn into fabric, we depend more upon handloom and power loom and less upon automatic looms, which is why the fabric which we make is not worthy of exports. Of course, some of us do export to Zara's and Kanalis and Banana Republic, but majority of our fabric is not export quality because we make it on handloom and power loom, which is why our share in ready-made garment is getting stuck at $17 billion a year. Bangladesh exports $25 billion, Vietnam exports $26 billion, and China exports $280 billion. Somewhere, our focus to create micro, small, mini enterprises has resulted into larger enterprises not being created. I will call this as India's South Korea movement. Why did micro, small, and mini enterprises get supported? Because they didn't have to pay tax, they could do transactions in black economy, hence they were giving unfair competition to large companies. Now, with GST demonetization, there is level playing field between large enterprises and small enterprises. This will result larger enterprises to grow faster. This I will call as India's South Korea movement. We got independence in 47. South Korea then was called Korea, got independence in 48. We were looted by Britishers for 180 years. South Korea got that benefit from Chinese and Japanese. India had at birth a neighbor called Pakistan, which was hostile, so we had to spend more on defense and less on development. South Korea got that benefit in 1950 with division between South and North, and they continued to have hostile relationship with each other. So effectively, if Manmohan Desai was making a movie and two countries had to depict that lost and found property, one was Korea, other was India. We were 4 times bigger than Korea in 1947. 4 times bigger in per capita GDP than South Korea. Today, we are $1,850 per capita GDP. South Korea has raced in a Ferrari to $29,000 per capita GDP. They are 16 times bigger than us. In 70 years, they have improved by 64 times compared to us. Are Koreans more lucky? Are Koreans more hardworking? Are Koreans more intelligent? Who knows? There are many things which probably would have resulted into this, but one simple example I want to give to explain why South Korea outperformed us by 64 times. In 1947, our largest company was Tata Steel. Britishers never gave them permission to expand because they wanted British Steel to come and sell in India. So at the time of independence, Tatas would have gone to Government of India and said, look, sir, we have iron ore mines, we have coal mines, we have water, we have land, and being Tatas, we have capital. Can you please give us permission to expand our steel making capacity? The Government of India came out with a law called Monopolies and Restricted Trade Practices Act, which didn't allow bigger companies to become bigger. We wanted bigger companies to become smaller. In South Korea, around the same time, there was a company called Pohang Iron and Steel Company. They went to their government and said, sir, we don't have iron ore, we don't have coal mines, we don't have enough water, we don't even have land in Korea, it's a hilly terrain, and we actually don't have money. But we know that if Korea has to progress, it has to make steel. Can you give us the permission? And Korean government would have said, ja beta chad ja suli pe. Pohang Iron and Steel Company became Asia's largest steel making company before the arrival of Japanese and Chinese. Korea outgrew 64 times because they allowed POSCO to become bigger. We probably didn't grow as much because we didn't want Tata Steel to become large company. With GST, with demonetization, there is level playing field. Hopefully, this will create acceleration in larger companies, and that will help us close gap with South Korea over a period of time. The third thing is financialization of economy. All of us are money-minded. All of us are monetary-oriented. Is that a fair statement? 110%, because if someone is disputing, I will just request him to hand over his wallet to me, and I'm sure no one would have done that. But let me prove to you that all of us are not money-minded. All of you have reached Vairagya level. How do I say that? On 8th November 2016, you and me had more currency notes in our tijori at home than equity shares in our demat account. The value of equity shares in your demat account and my demat account, including Nimesh Bhai, Rakesh Jhunjhunwala and Radhakishan Damani, was roughly about 9 lakh crore. The value of currency notes in your tijori and my tijori was roughly about 18 lakh crore. That 9 lakh crore was compounding at 15 to 20%. That 18 lakh crore was compounding at 0%. So effectively, if we were money-minded, we would not have kept so much money in currency notes. The fact is that all of us have reached vairagya. We don't really care for money. And hence, we were so careless. Not only we destroyed our portfolio return by being that stupid, we also destroyed India's opportunity. And I will call this India's China movement. In 1984, India and China were of similar size. Today, they are 5 times bigger than us. In 24 years, Chinese have outperformed us by 5 times. A slightly worse track record compared to South Korea, but still it's a great track record. Are Chinese more intelligent? Of course, yes. Are Chinese more hardworking? 110% yes. Are Chinese lucky to get their political leadership? Maybe. At the end of the day, India's and China's gap can be explained by just one single thing, which is total credit to GDP ratio for private non-finance entities. In India, banks didn't create enough credit to give to Tata Birlas and Ambanis, and whatever little credit they created, they end up giving to Vijay Mallya. Compared to us, in China, they have created credit to fund their Tata Birlas and Ambanis by 4 times bigger margin, 211%. And people said this number, 211%, is understated. It is actually 300%. So essentially, China created credit to fund their Tata Birlas and Ambanis to go and set up industries which created growth. Our banks couldn't create that credit. Why? Because all of us were interested in putting our savings into gold and currency notes. We didn't put money into bank deposits. How will our banks create credit? Now, इस कुत्ते की दुम को सीधी करने के लिए क्या किया? Demonetization. Government is printing less money than what is necessary compared to 8th November level. About 5 lakh crore has shifted from tijori to bank account by default because government is not giving you enough currency. Now, the only way this problem can be solved is if Pakistan prints fake notes and give it to you and me so that we can stuff our tijori. I don't think so Pakistan is going to be this time that helpful. Hence, 5 lakh crore will move from tijori to bank account. And if this bank money doesn't go to Vijay Mallya, then we have a great opportunity to close the gap with. These are the 3 things which is happening in India, which can actually create the momentum, which probably push South Korea from an emerging nation to developed nation, and which is pushing China from being an emerging nation to developed nation. Now, that comes to the mundane question, Nilesh Bhai, how do we invest? We have always advocated SIP, SIP, SIP. Now, many a times people come and say, "Kya Nilesh bhai, tumne galat advice diya." If we had put lump sum money, then your equity funds have delivered such a great return. Ye SIP, SIP mein to return nahi hai bana. So to all those people who want to make lump sum investment, please adopt Kumbhakarna style of investment. If you read Ramayana, it clearly shows that Lanka was gold-plated and Ayodhya wasn't. That means Lanka was far richer than Ayodhya. How did Lanka become so rich? Because Lankans followed Kumbhakarna style of investment, which was to invest in equity and go to sleep for 14 years. Any one of you, if you are going to go to sleep for 14 years, then please come and invest into equity even today 100%, lump sum, no SIP needed. Put blindly all the money in equity and go to sleep for 14 years. Since Ramayana, we haven't met Kumbhakarna, and it's unlikely to appear now. So the next best is to remember that equity market is like roller coaster. When you hear a presentation like this, India becoming next South Korea, India becoming next China, India becoming more efficient, you will like to take the ride in roller coaster. Moment the roller coaster will start, you will start cursing कि बस किसका बात सुन लिया. उस दिन कान बंद रखते तो अच्छा था. If you jump from that running roller coaster, you will break your head, you will break your legs. But if you can just close your eyes, pray to God, and sustain the up and down of roller coaster, by the time roller coaster comes to an end, you will feel very happy. You will enjoy that you have taken that ride. And after you get down and someone says that, ye roller coaster kaisa laga, you will be able to tell him that, boss, chad ja beta, maja aayega. So equity is like roller coaster, and right now, the downturn is coming. But if you can bear the pain, if you can withstand that downturn, there will be a fairly enjoyable journey. One thing which we want people to follow is valuation and allocation. Normally, there are three kinds of investors. People who haven't invested as much as they want to invest in risk assets like equity and real estate. People who have invested up to their neutral allocation, up to their desired level. And some people who are overweight compared to their desired level. There are three kinds of market: below fair value, like it was in December 2016, like it was in Feb 2016, like it was in October 2008, like it was in May 2013, or fair value market, which is what it is approaching now, or above fair value market, which was in Jan 2008. Now, if you are underweight and market is cheap, it's time to go for lump sum investment. Obviously, this is applicable to only non-Kumbhkarna investors. If you are Kumbhkarna, any market, any time, just get invested. If you are neutral, it's time to make some more lump sum investments to become overweight. You are neutral, market is cheap, it's time to become overweight. And if you are overweight, this is time to leverage. This is time to put your mutual fund units as a loan, call your RM, get the loan and reinvest more in mutual fund. This is the time to sell your cash holding to move into futures and options. You were overweight into market, market has become cheaper. This is time to leverage. This is time to leverage to invest. If you are at underweight and market is at fair value, you can do STP, or if you can do lump sum. At neutral level, keep on doing SIP. And if you are overweight and market is fair value and you are uncomfortable, you can take partial profit. If you are underweight and above fair value, keep on doing STP, but whenever there is correction like it is happening now, you prepone your STP to get invested into the market. In both the other cases, it's time to book your profit and take some capital home. Normally what happens, this is the time when people have leverage, and this is the time when people don't want to see us. This is called cocktail circuit syndrome, as explained by Peter Lynch. The first cocktail circuit is where Peter Lynch kind of fund manager goes into the party and people ignore him. People don't want to meet him. That's the surest sign that market is at bottom. The second stage comes when Peter Lynch goes to the cocktail circuit and people come to listen to him. People surround him. Are Peter bhai, kale su levanu. You know that's the beginning of the bubble. The third stage of market is where Peter Lynch goes to the cocktail circuit. People surround him and they tell Peter Lynch ke kale Sai Baba le leche. You know that's the top of the market. Today, depending upon how you surround me and what you talk to me, you can figure out where the market is heading. In our opinion, market was little above fair value. It is coming towards fair value, maybe few 100 points below on Nifty. Market should start entering higher end of fair value. No one knows whether markets will settle at fair value. Will it go below fair value? You'll have to take the risk. You'll have to manage the volatility. Remember the roller coaster ride. Recommendation: 1, keep faith in India growth story. Be a long-term investor. The forces of financialization, formalization, and efficiency is unleashing different India. Whether this budget or next budget, whether this government or next government, I think this is irreversible. Keep margin for event risk, especially the one big event risk which is going to hit us probably in fourth quarter calendar year 18, when we will start discounting next general election. FIIs will be back in India on good macros, though not necessarily on a daily basis. the number of FII visitors which are visiting Kotak Mutual Fund's headquarters is now increasing to once a week from once a month. And this is apart from when we go out to meet them. Our mid-cap fund recently crossed $2 billion in size. It's the largest mid-cap fund from offshore investing into India now. Our total AUM in offshore market has crossed $3.5 billion. It has propelled us ahead of HSBC, which is a far bigger and respectable name in global market compared to Kotak. It just shows the kind of traction we are getting in offshore market, and that traction gives us confidence that FIIs will be a net buyer in India rather than net seller. Last year was a bumper year. Calendar year 2017 delivered from 25% to 60% return on equity between large, mid, and small. This year, returns will be moderated. A lot will depend upon how 2019 election gets discounted. If it's a period like 2009, then we might see negative return. If it's period like 2014, then we might see a better positive return. If it's a period like 2004, then we might see kind of moderated return. I really don't know what's going to happen in 2019, how markets will discount that in 2018. But if you follow that asset allocation model, then I think you should be able to overcome that volatility. We had made this presentation a couple of months ago, and we were saying quality will pay over a period of time. There was one particular mid-cap IT company which was harassing us a lot. That stock was up about 70% in the period, and it was making our mid-cap fund underperform the indices. We were managing $2 billion mid-cap fund in offshore, $500 million mid-cap fund in local market, and we were underperforming indices because we thought it's important to focus on quality and governance rather than just chase the momentum, even though that stock is worth 3% in the index and it's giving us a pain. Today, I'm happy to announce that that stock is corrected 40% in just a few days, and my underperformance over index is over. We think even today there are some kachra stocks which are trading at a much higher value than their business value or their fair value, and they will all correct over a period of time. Don't chase momentum, please chase quality. Focus on your return rather than fund return. In fact, going for today, we make risk statement that past performance is no indicator of future performance. There is a consolidation of mutual fund schemes happening right now, and then the risk factor will get changed, saying that past performance is no indicator of past performance, because everyone is going to merge their bad performing scheme into good performing scheme and make the performance look far better than what it is actually. I'm happy to announce that at Kotak Mutual Fund, we don't have to merge any equity scheme. So our performance of past will be as good as what it is in reality. But many other mutual funds' past performance will be no indicator of their past performance because they will do this kind of accounting jugglery. Please try to allocate investment as per valuation cycle. This is not the market to be leveraged, undoubtedly. We recommend STP and SIP for investment unless until you can be Kumbhkarna kind of investors. The divergence in return between large, mid, and small cap will narrow. Last year, the gap was 30%. This year, the gap might be just 10%. You choose multi-cap, large cap, mid-cap, small cap based on your risk profile. Today, mid-caps were and small caps were at a huge premium to their historical value. They are coming down, but if you can take risk, it's worth embarrassing small and mid-cap now. If you want conservative allocation, then please remain in large and multi-cap. Rural, agri, and infrastructure themes looks promising based on what budget has given. And generally, in the run-up to general election, no government can afford to ignore rural population, farmers, and development of infrastructures. So this three sector over next 12-15 months could be better performer. Don't forget debt funds. Last year was horrible. Our debt funds delivered lower return than savings bank account. Not only Kotak Bank savings bank account, which delivered 6% return, even nationalized bank savings bank account, which delivered 3.5% return. In fact, some of our funds have delivered return below current account also, which gives 0% return. So it's not been a great year. But please don't forget debt funds, because there is one category of debt funds called credit opportunity funds. They will be less volatile compared to duration fund. And last year they have delivered decent return. And going forward, we think credit opportunity funds can substitute that portion in your portfolio which requires stability of return. If you are wanting to invest in non-credit funds, then one can explore fixed income funds. The interest rates are hugely volatile. Today itself, it has moved up and down by about 20 basis points. But if you want to take non-credit risk in your fixed income portfolio, then duration or bond fund also will be fine. We always recommend investors to take advice of their advisor or consultant before making investment decision, simply because of this. In Mahabharata, Kauravas took advice of Shakuni, it destroyed them. They took advice of Pandavas, took advice of Krishna Bhagwan, it gave them victory. In this battle of Mahabharata, where debt and equity markets are hugely volatile, there are geopolitical risk, oil price risk, interest rate risk, election risk, monsoon risk, you will need an advisor who can handhold you. And since in this Kali Yuga Krishna Bhagwan is not going to come, you will be happy to live with Kotak and Shobit. What's the risk in this entire India growth story? There is only one risk, and that is the risk of self-goal. We are capable of taking Rohit Sharma where Ajinkya Rahane is required. We are capable of taking Ramchandra Ashwin or Ravichandran Ashwin when Bhuvneshwar Kumar is required. That's the risk of self-goal. You know the story of Singur and Sanand. Singur was the place where Tatas wanted to set up their automobile plant. Political protest and other things pushed them to move to Sanand. Everyone knows this. But what happened to Singur and Sanand later on? This is what has happened in Singur and Sanand. In Sanand, bank deposits have crossed 3,000 crore in last 7 years. It has not become as prosperous as Singapore, but it is far, far better than Singur. You could see signs of prosperity everywhere. People traveling in motorbikes, people traveling in car, new restaurants, new retail shops. Singur has migrated from being a sleepy town to a vibrant town. Sanand has migrated from being sleepy town to vibrant town. What has happened to Singur? Every bank which opened a branch there hoping that there is Tata Motors business is now shutting the doors because there is no business. There is nothing left in Singur. If rest of India is going to follow Singur model, this is the best time to sell your equity portfolio because you won't get this prices. If rest of India is going to follow Sanand model, this is the best time to invest in equity market because again you won't see this kind of prices. Our problem is that majority of India will follow Sanand model and some parts of India will follow Singur model, and that's why our journey will be up and down like roller coaster rather than straightway going up. This is the picture which all of you would have seen at some point of time in your childhood in various shops. I gave credit, became bankrupt. I sold for cash, making money. I think this picture will also apply to trader versus investor. Trading will give you some success, but eventual failure. Investment will give you some failure, but eventual success. And let me tell you a story about a gentleman called Jesse Livermore. He is the Donald Bradman of equity trading. His book, Reminiscence of a Stock Operator, is a Bible for traders even today. In 1929, when New York stock market crashed, most of the brokers were living in one particular area. The market started crashing from 10 o'clock in the morning when it opened. By 2 o'clock in the afternoon, one of the most prominent stockbroker of that area committed suicide. That news reached in the locality, and every stockbroker's family was afraid. Today, how many of our people will come back? At about 4:30 after the market closed, Jesse Livermore was coming home. His wife rushed to console Jesse, saying that, Jesse, don't worry, markets have fallen, but we can still survive. We can sell this house, we can move to hinterland. It doesn't matter. As long as we have life, we can prosper. Jesse Livermore replied to his wife saying, what are you talking about? Yes, we are going to sell the house, but that's to buy a bigger house. I have made huge profit today. On a day when rest of the New York stock market lost money, Jesse Livermore walked home with $1 billion equivalent of today's value profit. That's why he is called Donald Bradman of equity trading. What happened to such a successful guy who could make $1 billion when everyone else lost money in 1933, just 4 years after 1929? He incurred so much losses trading that he finally committed suicide. So if you want to trade, please keep a portrait of Jesse Livermore in front of him. You have to be better than him to make money. I don't think so. There are people who will be capable of doing it. So please remember, if you trade, left-hand side of picture is you. If you invest, right-hand side of picture is you. These are all the risk factors which we are supposed to disclose. Please don't bother to read them, otherwise you'll never be able to invest into mutual fund. You can follow us on Facebook. Our Facebook page is www.facebook.com/KotakMF. Or you can follow us on Twitter, where we continue to share such information. Thank you for your presence. Happy to take some questions.